welcome to Market Domination. I'm Julie Hyman, Canal in for Josh Lipton today, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's a headline blitz getting you up to speed 1 hour before the closing bell rings on Wall Street.
What we're seeing is a very broad-based conclusion or opinion among consumers that inflation is going to pick up in the year ahead as well as the next 5 years. It was a pretty large month-over-month increase for both short and long-run expectations. It's not necessarily cause for panic at this moment, but these expectations are clearly being driven by concerns over policy, concerns that tariffs are going to lead to price hikes, and it's very anticipatory on the basis of consumers.
Our view is that there's still upside for the S&P between now and year end, but between here and there is probably an ongoing period of volatility concern that keeps us looking for pullbacks as better buying points.
Let's take a look at United Health Group, responding to the Wall Street Journal report that claims the Justice Department is investigating the company's Medicare billing practices. United Health Group says the journal, quote, continues to report misinformation on the Medicare Advantage program. The journal's report claims the new civil fraud investigation is examining United Health's practices for recording diagnoses that trigger extra payments to its Medicare Advantage plans.
We got 1 hour to go until the market close. So taking a look at the major averages, the selling is worsening as we head to the weekend. You know, there's an old market view that you don't want to be long into a weekend if you've got the sell-off happening. Maybe that's part of what's going on here. But we did get some economic data today that disappointed. So right now, the Dow is down 780 points, 1.7%. The S&P down 1.7% as well. And by the way, for both of these averages, it's the worst sell-off since that Fed meeting on December 18th that triggered a market sell-off. The NASDAQ down about 2.2% today.
Yeah, just an ugly day on Wall Street. You mentioned some of that economic data. We have consumer sentiment falling once again for the month of February. We have long-term inflation expectations over the next year and also the next 3 to 5 years rising sharply again for the 7th straight month. Now, despite that, we are seeing yields under pressure a little bit since there's this risk-off sentiment in the market right now. You're seeing yields hovering around that 4.4% level. So it's one of those things where when you have bad economic data, we have these TBD factors of tariffs and some of those policy concerns. And as you mentioned, heading into the weekend, not a great picture on Wall Street.
Right. So even though those inflation expectations may be ticking up, some of the other economic data we got today, whether it was existing home sales or a PMI reading on services that showed contraction, you know, it's a complicated picture, I guess, is the bottom line. But we've also got some individual stocks that are really pushing things around here today. This is a look at the Dow components. I'm going to equal weight it so that we can get a clear look at United Health falling by nearly 7%. This is on reports that the government is looking into the company's billing practices, particularly for Medicare Advantage. We're going to get some details from our Anjali Kamlani later, but you see obviously what's happening with the stock.
Yeah, and the sector action is interesting as well because consumer discretionary is underperforming the market there, and it actually has erased all of its gains that we saw since the end of November. So definitely not a great picture on the consumer side. And it's interesting, Julie, because heading into this week, we had all the sectors in the green. Things felt good. We had record highs. And now we're seeing us end the week on a slightly more sour tone.
Yes, most definitely. So let's talk more about the outlook from here. We did get more signs of weakness for the U.S. economy, taking a heavy toll on the market today. 3 separate economic reports, all coming in below economists' expectations. First up, that reading on the services sector, contracting for the first time in 2 years. Consumer sentiment falling to its lowest level since 2021 in February, and a reading on existing home sales tumbling by nearly 5% last month. Stocks sliding across the board as a result of all of this. The major averages now on track for weekly declines. Joining us now, Michael Darda, Roth Capital Partners chief economist and macro strategist. And Mike, really, you are the perfect person to talk to about this because what we're seeing does have a heavy sort of economic component here. What do you make of what we're seeing today?
Well, this is still a fairly minor pullback after a 2-year period of totally uninterrupted stock market gains for the S&P 500. So not at all surprising considering how high valuations have gotten. And the reality is we've got a lot of policy uncertainty in front of us. The Fed is on indefinite pause now, more concerned about some recent warm inflation readings. You mentioned the University of Michigan data for February. That 5 to 7 year inflation expectation reading is at the highest level since 1995. Now, the mid 90s were not a particularly inflationary period, but I don't think the FOMC is, it is flattered by the direction, which is up and to the right. It's not what they want to see. And then, of course, you have a fairly chaotic policy environment brewing in Washington with tariffs on and then tariffs off and then tariffs on again, stricter immigration policies that'll slow down labor force growth. So if those things are hurting the supply side of the economy, and now we've got news of some kind of gimmicky Keynesian rebate with so-called Dodge savings, which is the wrong policy. Look, if the Fed is worried about inflation and it's on pause because it doesn't want excess demand to push inflation or to continue to elevate inflation above target, if you come in with a tax rebate that potentially stimulates demand, the Fed could go back to hiking interest rates in that environment. So it's a bit of a mess from a policy perspective, and that mess is occurring with very high stock market valuations on a historical basis.
And there's also a lot of unknowns surrounding that mess, right, Mike? Because when we think about the tariff situation, the only levies that have been implemented have been those 10% tariffs on China. Everything else is TBD. You mentioned the consumer sentiment survey, those long-term inflation expectations. That's been anchored on these tariff fears. So do you think the market is overreacting a little bit to some of the headlines that are out there, and we should take a more wait-and-see approach?
I think on the inflation side, there could be a bit of an overreaction going on. There are some other surveys that come out of the New York Fed, and we've got data just in the past week that showed very anchored inflation expectations. The bond market inflation expectations readings still look okay. They have been moving up on a 10-year horizon. In the 240s, that's a pretty good level. That's consistent with the Fed hitting its target over time, since the PCE deflator, which is the Fed's formal target, tends to run a little below the CPI inflation rate. And that's what those tips are based on. If you look at the shorter horizon bond market inflation expectations, like the 2-year and the 5-year tip spread, they've risen quite a bit. And so I'd like to see those actually break lower. So, there are some warning signs here. I mean, it's really an environment where we've had the Fed pull a rabbit out of a hat. They were able to hike interest rates 500 plus basis points, slow inflation, slow nominal growth, and not kill the economy. I mean, it's really historic, a black swan in a good way. So at that moment in time, you've got high valuations because of a lot of optimism over AI and the business cycle soft landing. And now we're taking risks, tinkering around with tariffs and trade policy in a chaotic way. We know the immigration situation was going to be addressed in one way or the other, but that will slow labor force growth. So, if the tariffs hurt productivity, if labor force growth is slower, the supply side, the growth potential of the U.S. economy will weaken, and that could make the Fed's job more difficult in terms of gauging inflationary pressures and calibrating short-term interest rate policy. So it just seems to me like we're taking risks in an environment where you're priced for no risk.
Well, and on that point, that last point, Mike, I've seen a meme a couple times online about the markets here where they react negatively to a headline about tariffs, for example, and then the market sells off a little bit, and then investors remember, according to this meme, that the president cares about the stock market, and things go up again. Do you think that there is sort of a complacency here about the president's attachment to the stock market and about his unwillingness to do things that will indeed cause market pain?
I do. I think that could be a real gross miscalculation on the part of investors that Trump's second term is going to be focused on babysitting the S&P 500. he hasn't tweeted about the stock market in a little bit, and he tweets about pretty much everything, or sends out social media posts, and whether it's Truth Social or X. So, we could be in a situation where the focus is really on reshaping the global trading system and erecting these tariff barriers, to address imbalances, real or perceived. And if the cost of that, recently the president said the cost, could be a bit of a disruption, but he thinks people understand that. So maybe he's not going to be so concerned if there's a stock market correction. And the question is, if you do get into a corrective shakeout, and I don't think we're there yet, this could be the front edge of it. But investors have been rewarded for buying every single pullback, and eventually that won't work. And when it doesn't work, it could be watch out below. And at that point, is a social media post and a quick verbal U-turn going to be enough? It may not be. So it's a very good question, and I do think investors are really just conditioned to assume that stocks only go up. We don't have corrections, we don't have bear markets, we don't have recessions, we don't have policy shocks. All of which, if you look at the historical track record, would be sorely, sorely mistaken.
So as an investor then, how do you play this market and really navigate a lot of that volatility? Well,
I think, hedging and diversification is really the name of the game here. I just, before we started the interview, brought the S&P 500 10 or 11 major sectors up on my screen. And as it turns out, even when the market was making new all-time highs, we were being led by a lot of the traditionally defensive areas. Consumer staples, healthcare is the top performing sector in the S&P 500. So we've advocated for some time on your show and others that investors use a barbell approach, that they have some safety in the portfolio, some shock absorbers, whether that's treasury bills or longer term treasuries or defensive equity sectors. And then if there's a portion of the portfolio and you want to go Evel Knievel and chase, momentum and super high valuation stocks, fine. But understand the risks on both sides. It's not just, free money straight up into the right all the time. And unfortunately, I do think there are a lot of investors that seem to believe that. And I've heard a lot of anecdotal stories about folks who are in their 70s who have totally undiversified portfolios in the 6 or 7 names that have dominated the S&P 500. And they think they're bulletproof because everything's gone straight up for 2 years. And it wasn't long ago in 2022 where those areas took a very steep fall. And we certainly know what happened after the internet revolution, and that was transformative. But we also ended up with a nearly 3-year bear market on the backside. So that's what I would tell investors: diversification in balancing out the portfolio with barbell strategies, I think, is super important, especially at a time like this of high valuations and rising policy uncertainty.
Michael Darda, it is always a pleasure. Thank you so much. Appreciate it.
Thank you.
We're just getting started here on Market Domination. Coming up, we're tracking the market sell-off all hour as we count down to the closing bell. We got to look at the biggest movers, including 2 key names to watch in the healthcare space. Everything you need to know straight ahead.
Wall Street awaits Nvidia's fourth quarter results next week. The options market, though, is anticipating approximately a 7% move higher or lower in the stock following earnings. And what's notable about this, Julie, is that 7%, that's a little bit less than what options had expected in prior earnings over the past 2 years. Now, to keep it all in perspective, 7%, you're still either erasing or creating about $240 billion of market cap. Right. But for a company like Nvidia, which is so volatile and has been so important to the stock market and the rally that we've seen over the past 2 years, perhaps this implies that maybe it's not as important. And you actually wrote about this morning in the Yahoo Finance morning.
I did, just because the Magnificent Seven has not kept pace writ large with the market gains that we've seen this year. Nvidia, which accounted for 20% of the gains in the S&P last year, has accounted for about 5% or so of the gains this year. But it's also a more diverse group of stocks that is leading gains this year. JP Morgan's on the list. Walmart was on the list at least until the losses that we saw after the earnings. So we have seen a bit of that market broadening. But in terms of how people are are setting up ahead of those numbers. Earlier today, our Yahoo Finance colleagues talked to David Bull about the options action. He's Baycrest Managing Director of Equity Derivatives, and here's what he said about that setup.
The setup I'm seeing from clients is that it's certainly less overowned than it was over the last 2 years. The numbers are likely to be pretty strong, but how good could it be with, the rest of their major customers already reporting big CapEx numbers? I think the sense is, what can they say that's going to really drive Nvidia up another 20% in one day? But if anything, this could be an overhang removed, and the stock could then grind higher over the next couple weeks or a month.
The sort of stunning reports that we get from Nvidia might be behind us, just because it's more of a known quantity now, even though it's not growing at triple digits anymore in terms of revenue, even though revenue is still predicted to grow 73%, which is still
huge.
Pretty mind-blowing, especially for a company of that size. But nonetheless, it doesn't any longer, well, maybe it does. I'll say this and then Nvidia will make a fool out of me. It doesn't necessarily have the same ability to surprise the market to the same degree.
And we've seen this broadening out of the market too, like you were alluding to. It's not just all about the Mag 7 anymore. It's not just all about Nvidia carrying those gains. Revenue, like you said, has been slowing. I am curious to hear if they say anything interesting about the DeepSeek sell-off that we saw, or maybe the competition, things like that. But overall, markets seem to have largely shrugged that off and maybe interpreting it as a possible good thing when it comes
Potentially,
to
yes. And of course, the one other thing, we'll be looking for any commentary on Blackwell, on whether the company's manufacturing ability has sort of caught up here, where the supply is catching up with demand. That's going to be important.
Yeah, catching up with demand. And I feel like overall, all the Mag 7, the hyperscalers, they've been spending. So I feel like the demand picture likely going to remain pretty steady at this point. But while there will be lots of focus on Nvidia earnings next week, we are taking a look at the bigger chip landscape today. The group as a whole is positive on the year, but that doesn't mean every stock is in the green. While Intel has seen its stock surge nearly 25% on acquisition reports, Skyworks is down 25% so far this year. Joining us now to help make sense of this sector is Christopher Danely, Citi head of U.S. Semiconductor Research. So Christopher, let's start there. We've seen a lot of dispersion within these semi names. So how are you advising your clients to really kind of parse through all these various companies and really what the market is telling us right now?
Sure. So first of all, we start with the cycle because the cycle determines largely the movement of semis overall, and we're still positive on the cycle. When it comes to, say, an Intel or a Skyworks, Skyworks lost a major design win to Broadcom, so that's what's weighing on them. And it's in an area that's commoditizing, so we don't like Skyworks. Intel, like you said, has really bounced hard. I think a lot of that is short covering, to be perfectly honest. I think Intel's been one of the more popular shorts out there in semis. And then whenever you introduce some unknowns, such as breaking up the company, government's getting in there, the shorts just sort of back off and say, hey, I don't know what's going on here. I think that's largely what's happening there. But as far as the space goes, like everybody else, we're still very, very positive on everything AI. So that's Nvidia and Broadcom. But also, I think you're seeing other parts of the sector that have been, down in the dumps for the last couple of years, like semi-equipment names, like Applied Materials and Lam, or the analog space, which has done absolutely nothing for the last couple of years, is finally showing some signs of life. I think that was the most important new development that came out of earnings. We upgraded one of those names, NXPI, earlier this week. We upgraded a couple of them throughout last year, Texas Instruments and Microchip. I think that's going to be one of the bigger surprises this year. And we're saying to investors to allocate like new dollars over to the analog names.
And where are we in that analog cycle that's leading you in that direction, Chris?
Sure. So a couple things. If you look at the the margin trajectory of these analog names, unlike say AI, where margins for those companies are at all-time highs, for the analog names, they've largely fallen anywhere from 10 to 15%. Take a company like Texas Instruments, for example. Their margins have fallen 15%. That's the biggest decline in their margins since the global financial crisis. Obviously, it doesn't happen that often. Also, if you look at the revenue for the analog companies, it's down on average 30% from the peak of a couple of years ago. So clearly you're trending below consumption there. We're starting to see some signs. We've had multiple companies talk about their bookings increasing from a variety of sources across the board, distribution, direct customers. So that space is pretty much at the bottom, and you're starting to see some signs that it's coming back. As a result, you're also seeing some of the stocks jump rather sharply over the last couple of weeks. A lot of them are up like 10-20% in the last couple of weeks. But if you're buying them here at the bottom, 10-20% is nothing. Texas Instruments, that's our top pick there. Another example, we think earnings can go up literally 100% at Texas Instruments. So wow. We could be really at the beginning of a multi-year upturn in analog.
Chris, I want to get your take on a potential breakup of Intel, because you seem to have a more bearish take than at least some of the investors do, considering that huge surge that we saw following that report. Why don't you think a breakup of Intel would be in the best interest of shareholders?
Sure. So there's a lot of synergies. Basically, the proposal is separate Intel into manufacturing and then the design of the chips, right? So there are a lot of synergies. And the analogy I would use is building a semiconductor is like building a house, right? It takes 3 months to make a semiconductor. There's a lot of layers, there's a lot of steps. And so the design and the manufacturing is like the architect and the contractor. Probably in your best interest to have the architect and the contractor working closely together. It's the same thing with the designers of the chips and the manufacturers of the chips. I know, several people that work at various semiconductor companies, let's say on the design side, and they're always like going back to visit the factory as they are manufacturing these chips. So I think if you break up Intel, you lose a lot of those synergies, and it's going to hurt the company. I think that if they want to sell off some of the non-core aspects like an Altera or Mobileye, that's no big deal. But I think you do need to keep the core businesses together.
Well, but at the same time, Chris, I believe you think that they need to get rid of the so-called merchant foundry business. In other words, right. I think what you're saying is they should keep making their own chips and working on that process, but they shouldn't necessarily be manufacturing chips for other people. What happens to that business then if it's not, a TSMC or someone who buys that? Or could that be a potential outcome?
Yeah, that's a great point and a great question. So we have this top 15 rules of semiconductor investing, and one of those is it's an axiom, and just in tech investing overall, that tech companies and semi companies are generally good at doing one thing really well. And if they try and get outside of their core competency, it tends to meet with failure. Intel is fantastic at manufacturing leading edge microprocessors. They've been doing it for 50 years. If you get outside of that, they've been trying to do merchant foundry, making chips for other companies for the better part of 20 years. And it hasn't worked for 20 years. They bought a company, Altera, about 10 years ago. So they own Altera. They've owned it for 10 years. They still can't make Altera's chips. Altera's still making them at Taiwan Semi. So it's not like, I'm pulling this out of a vacuum or something like that. So I think if they do get rid of the merchant foundry business, it's not that big a deal. They don't really have much of a business there, right? So you can just shut it down or spin it off. I don't know if they could sell it, but really it's a fairly small business. The biggest part of it is the billions of losses that they're having every quarter. You shut that down. We've done the analysis. You have a path to $3 or $4 in earnings. That's a $50, $60 stock. I think it's great. I think Intel holders should and would love it. And, in all fairness to Pat Gelsinger, I think Pat had them on that track back to drawing at least close, if not even with the competition by the end of this year. Now, I think his sort of fatal blow was he was still pursuing the merchant foundry business and it was killing him. But I think, Intel has a solid chance at getting back in manufacturing now that Pat's gone and they've had some other high-level defections. That path to recovery is now in jeopardy, unfortunately.
Yeah. Well, Chris, it has been a fascinating story to watch, certainly. Thank you so much for your perspective. Appreciate it.
Happy, have a good weekend.
You too. Now time for some of today's trending tickers. We're taking a closer look at a couple of healthcare stocks, starting with United Health Group. That stock is moving lower due to reports that the Department of Justice is investigating its Medicare Advantage insurance business. Joining us now with more is Yahoo Finance's Anjali Kamlani. This has to do with billing. Talk us through what exactly is being looked into here.
Well, there's a question on what's being looked into here. So let's recap what happened. The Wall Street Journal reporting this morning that they have news of an investigation into Medicare Advantage billing. The United Health then countering with their own statement saying the Wall Street Journal continues to report misinformation on the Medicare program. They've done a couple of reports over the past year, and they said they're not aware of a launch of any new activity as reported by the Journal. We also got a note out from JPM analysts saying that they're cautioning investors against jumping to conclusions on this report, and they expect that if there is anything, the United Health is going to be defending their practices, of course, but that it could just be a regular audit at this time. So there's a question on what exactly is happening. We have seen, of course, a stock down on the news and awaiting any confirmation on what exactly is going on.
All right, Andrew, next up, I want to get your take on Hims and Hers Health. That stock is tumbling today after the FDA announced the shortage of semaglutide injection products such as Novo Nordisk's Ozempic and Wegovy has been resolved. So, Anjali, what can you tell us about this and what that means for a company like Hims and Hers?
Hims and Hers definitely going to get hit with that. Now, they do have a little bit of leeway. What we do know is that the FDA confirmed what we had been anticipating, which is Novo Nordisk saying that their shortage is also over. That makes them join Eli Lilly, which had already got its GLP-1s. Now remember, these are the blockbuster diabetes and weight loss drugs that are new and really popular. Patients still say they're in shortage, but the companies have been able to convince the FDA that they are not. And so right now what we're looking at is the impact on telehealth platforms like Hims taking a hit. They do have a 90-day window to continue selling these products, but others like Sesame Care and Ro also, who are also part of this, are definitely going to get dinged. Sesame Care actually wrote a letter to their patients saying that, just so you know, manufacturers are allowed to still sell this for 90 days, and the medication remains active for a year after being purchased. So it could,
people could hoard them.
People could hoard. You can stock it up. So that's really where things are right now. And what it means is that we're going to be watching how this impacts Lilly and Novo's business over the coming year to have the compounders out of the marketplace, so those knockoffs that were allowed because their drugs were in shortage. What happens now with their selling, with their throughput as well, because we know manufacturing is a big key in that.
And to be clear, those platforms cannot sell the branded versions of the drugs.
They can sell the branded versions. It's just because they're in shortage, they're sort of lower priority. Ro does have a partnership with Lilly to sell direct, so that's one area where they could potentially see a higher throughput. But the reason why they partnered with the compounders is because it's a cheaper option and easier to get access to. So that's why that has been on the market this whole time.
Yeah, interesting to continue to track that supply and demand picture there. Anjali Kamlani, thank you so much. Well, a busy day in the crypto space. Coinbase saying it's reached an agreement with the Securities and Exchange Commission that will drop its enforcement lawsuit. We'll hear from SEC Commissioner Hester Peirce. That's next.
Welcome back to Yahoo Finance Live. I'm Jennifer Schonberger. I'm joined now by SEC Commissioner Hester Peirce, who has been charged with leading the new SEC's crypto task force. Commissioner Peirce, thank you so much for sitting down with me. It's great to have you back on Yahoo Finance.
Jen, it's great to be here. Thanks for having me.
Coinbase announced this morning that the SEC has dropped its lawsuit against the firm to register as an exchange with the commission. I understand there's supposed to be a vote next Thursday on this. Would you vote in favor for this, and could we see this lawsuit dropped once and for all next week?
I'm sorry, but I can't speak about ongoing litigation.
Would you support dropping such a lawsuit?
Unfortunately, I just can't speak about ongoing cases.
Curious whether the commission is changing its stance on how it views digital tokens. Before, many were viewed as securities. Is the SEC changing its view to seeing many viewed as commodities now?
Well, I've always had a little bit of a different approach than some of my colleagues on how we think about these things. And so what I'm hoping that we can get to is a place where we have greater clarity around how we're thinking about things in a legal framework that is workable, that is consistent with the statute, but also enables people to figure out what something is categorized as without hiring lots of lawyers and having the fear of litigation hanging over them.
To your point, under the last administration, we saw that the SEC declined to write customized rules to govern crypto. Many tokens were seen as securities, and thus companies were told to abide by the rules on the books. Could we see the SEC write customized rules to govern crypto this year? And could we see clear definitions for what constitutes a security or not?
Well, I think we will work on trying to provide more clarity, and there are several ways we can do that. We can use guidance to help people understand where things fit, whether that's staff level or commission level guidance. And we can also write rules, which for all of these things we'll be trying to interact with people and find out where they need clarity and get people's suggestions about how to move forward. Some of the work is going to be done here at the Commission. Some of the work will probably be done in Congress as well. So timelines are a bit hard, but we are definitely working and trying to work quickly to get people some clarity early on.
Do you think we'll see something this year?
Again, whether or not a rule gets done this year, I don't know. And I should say that I'm speaking only for myself. We're getting a new, we have a new chairman likely coming in relatively soon, and he'll have ideas about where the agenda should go and what should be on the agenda. But I think rulemaking could be part of what we do.
I want to go back to your statement on February 4th, where you said you're thinking about recommending action to temporarily offer relief for digital coin offerings to be deemed non-securities for the time being, again, temporarily, so long as they filed with the SEC certain information and kept that information updated. And that could actually be retroactive, you said in your statement. Are you planning to move forward with that? Is the SEC planning to move forward with that?
Well, it's something we're considering, and it's something I've been thinking about now for a while, which is, can we give people at least the ability to try to launch a project, get network effects, get people using a token, because that's really the point of a lot of this, is to try to get decentralization and lots of participation, and that can sometimes run into the securities laws as we've applied them. And so thinking about how we can get projects a road forward, and one that involves disclosure so that people who are buying the tokens have some sense of what they're buying. I think that could be a real positive to do that early on, even if it's just a temporary fix while Congress is working and while we're working on rulemaking. So we're very interested in what people have to say about this, but this is one of the things that we're looking at.
Is it under serious consideration?
It's under serious consideration by me. Certainly, yes.
I also want to ask you about, under the last administration, a lot of crypto companies, including Coinbase, had real difficulty registering with the Commission. Do you anticipate any changes associated with that process?
Well, I do think that we need to do more than just tell people they can come in and register and then when they get here, shut the door, which has been sort of the past practice. So I'm hoping we can have a practice where people can come in and talk to us, and we can think about when registration is necessary, and if it is necessary, are there accommodations that we need to make using the tools that Congress has given us to make accommodations. Again, our securities laws, we have objectives that we have to meet as a securities regulator, and we're not going to throw those out. That's not our plan. But we do think that we can both achieve our objectives of protecting investors and protecting the market's integrity, and also achieve the objective of allowing people to do things in this space.
Under the last administration, spot Bitcoin and Ether ETFs were approved, but they were not given in-kind redemptions. Could we see that changed? And what about the potential for greenlighting options for Ether ETFs?
So in terms of staking, that is something that people raised with us early on after these products went through, and it's something that I'm open to. I think I'm happy to talk with people about that. Adding that, I know that that's something that exists in products in other jurisdictions. In terms of options on ETPs, that's something we're open to as well. We're getting lots and lots of incoming exchange-traded product applications, and we'll be considering them on their individual facts and circumstances and processing them just sort of as we routinely process these things.
The president this week signed a new executive order stating that independent agencies should submit major regulations to the Office of Management and Budget for review. How will that impact the SEC's rulemakings, not just for crypto, but in general?
Broadly, yeah. I mean, I've been a believer in the importance of economic analysis, and that means asking the question, what problem are we trying to solve? What tools are available for us to solve that? How can we pick the best tool? And OMB, and specifically their OIRA office, can be really helpful in helping us think through how to do that because they're experts in this. So I'm certainly looking forward to working with them on helping us make sure that our economic analysis is really serving the fullest potential that it can serve.
I understand based on Doge's website, it looks like Doge has been inside the SEC. Can you confirm that? And what do you expect from Elon Musk and his team in terms of cuts and the impact potentially on surveilling capital markets?
Well, I can't confirm that, and I think one of the interesting ways that the SEC is set up is we have a commission. There are 5 of us. Now there are 3 of us, but if we're fully staffed, there are 5. But the chairman does have authority over the budget, the staff, and the agenda, and so I think those contacts would be with the chairman's office. In terms of thinking about how we can run the agency efficiently, that's something that we're always thinking about. It is very important. We feel that we have a real responsibility. We have excellent staff here, and we want to make sure that they're working on the most important projects that they can work on. And so thinking about how to do that best is something that is always front of mind for us.
Your colleague and acting chair, Mark Ueda, ordered SEC lawyers to delay oral arguments over a rule that would require companies to disclose the impact of climate change on their business. Is that a signal that the SEC is going to be rolling back that rule? And what other reversals could we see from the last administration?
I think the Commission hasn't made decisions on that, but I have had concerns about that rulemaking, certainly, and I expressed them pretty vociferously at the time that we proposed and adopted those changes. I'm sure we'll be thinking about these kinds of things. And in terms of what we're going to do on other rulemakings, again, that's the agenda is very much a work in progress. It's something that we're thinking about what should be on the agenda, what should be off the agenda. There are rules that have been proposed but not finalized. We have to think about how and whether to move forward with those. So there's just a lot of work to do, and it's hard to know where all of that will fall out. I will say that I think capital formation is something that will come back onto the agenda in a way that will be really positive. It's been off the agenda, and I think we'll be spending some of our resources on trying to improve capital formation.
I'm curious, the U.S. President Donald Trump is participating financially in the same industry that the SEC is being asked to oversee. His media company is set to launch the Bitcoin ETF, I presume a vehicle that would need to be approved by the SEC. Does this create any challenges for SEC oversight as you're looking to also work with the White House and the White House overseeing some of what you do?
I think what we do is we look at every incoming application on its facts and circumstances, and we take into account, the unique facts and circumstances associated with each, and we'll do that with respect to anything that comes through the door.
Commissioner Peirce, thank you so much for your insights. So appreciate it. Hope to speak with you again soon.
Thanks for having me.
That's SEC Commissioner Hester Peirce. We will be right back after this.
Gold is looking for its 8th straight week of gains, and our next guest is lifting his year-end gold price forecast to $3,100 per troy ounce. Joining us now, Daan Struyven, co-head of global commodities research at Goldman Sachs. Indeed, your team just raised this forecast, but talked about that there even could be more upside. Talk to me about the role of central bank buying of gold in your outlook here, Daan.
Yeah, thanks a lot for having me. So the main reason while gold prices continue to hit new all-time highs, and the main reason why we look for additional upsides to $3,100 per troy ounce by year-end, is this structural increase in gold purchases by central banks, in particular by reserve managers in emerging markets. What happened in 2022 is that when Russia's central bank reserves invested, for instance, in treasuries or fixed income in other developed markets like Europe. When those reserves were frozen, it was a wake-up call to EM central bank reserve managers because they realized that their assets would not necessarily be risk-free. And so they have shifted part of their reserves to buying gold, an asset which cannot be frozen or confiscated. And so we have seen a five-fold increase in the rhythm of gold purchases by central banks. We think this is a structural shift, and we expect ongoing solid, above-trend central bank purchases of gold to continue to push gold prices higher.
So central bank buying, a structural shift, as you say. What are some other catalysts that will push up gold demand and lead to some of those higher prices?
So we also have a boost from our expectation that interest rates will come down globally. In particular, our US economists look for 2 Fed cuts this year. And if interest rates come down, that increases demand for gold from investors because the interest rate is essentially the opportunity cost of holding gold. That's a key driver. We also see a lot of value in investing in gold as a hedge against policy uncertainty, trade tariffs, uncertainty about inflation. And so if policy uncertainty were to remain at high levels, and if speculative positioning, which tends to be high when uncertainty is high, if speculative positioning were to stay at currently high levels for longer, our model would point to a gold price by year end of up to $3,300 per troy ounce.
And does that imply that even if rates don't move down, as your economists are predicting, that even just the policy uncertainty could still propel gold to those levels?
Yes, that's right. We think the 2 quantitatively key drivers of gold prices are, number one, structurally higher central bank purchases, and second, uncertainty. Interest rates matter, and for instance, if the federal funds rate were to stay flat this year, we would still be forecasting gold prices above $3,000 per troy ounce. The quantitative big drivers are very much central bank buying and policy uncertainty.
Daan, I also want to get your take on oil. You see the price of Brent ending the month at $79 per barrel. We're currently trading around $74 a barrel. So what would be the biggest drivers to the upside in your view?
Yeah, so we continue to expect Brent to trade in what we've called the 70 to 85 range, or WTI that corresponds to 65 to 80. And we look for some short-term upside in our base case, because inventories are quite low. And in fact, our valuation model for oil suggests that oil is currently underpriced by $6 to $7 per barrel. In fact, if you just add up all the oil inventories you can see globally, both crude and refined products, they have fallen to mid-2022 levels when oil prices were in triple digit territory.
And also, of course, there's some geopolitical uncertainty with regards to things that affect oil as well. And one of the most interesting things you recently wrote about was the effect of what could happen in Russia. If there is an end to Russia sanctions, if there is a resolution to the Russia war in Ukraine, you don't necessarily think that's going to mean a flood of oil supply coming to market. Why not?
Yeah, that's correct. So if you were to see a ceasefire in Ukraine, our working assumption is that you would likely see a significant return of natural gas flows from Russia to Europe, for instance, via Ukraine. And that could lead to a 50% drop in European and global ex-US natural gas prices and cause 0.5% of GDP upside in Europe. However, while sanctions are constraining natural gas flows out of Russia, we don't think sanctions are constraining Russian flows out of Europe. Why? Because the key constraint on Russian oil production is production quota that Moscow has agreed with Riyadh in the context of the Russia, Saudi Arabia, OPEC plus agreements. And so if you were to see a ceasefire, if you were to see a removal of sanctions, for instance, on purchases by Europe of oil, it could affect who buys the oil. Maybe Europe starts buying it as opposed to India and China. But we don't think it would change the volumes of oil in the market and would therefore not have large negative effects on oil prices. So a big contrast here between a potentially big downside for natural gas prices and more limited downside for oil in the context of a potential ceasefire in Ukraine.
Don, how worried are you that an increase in inflation and a slowdown in global growth potentially can impact the demand picture there for oil?
Yes, so if, for instance, global growth were to come in a percentage point weaker than our forecast of growth, sort of in a 2.5% to 3% range, over time, that could cause up to roughly $10 per barrel downside, but it would take time. And a 1 percentage point slowdown in global growth is a pretty big shock. And it would take time because oil prices tend to pretty much price what we call spot fundamentals, inventory levels as we see them. And it would take time for global GDP to be softer than our base case, and therefore for oil demand to be softer than our base case, and for inventories to build. And in fact, gold would do well in such a scenario.
Right, that makes sense. One more thing I wanted to ask you about is President Trump's sort of attempts to influence global oil markets, right? He has talked about trying to get the Saudis to pump more to bring prices down. He certainly talked about that here in the United States as well. You know, especially if your prediction is that we're going to see oil prices tick up here closer to $80 a barrel, are his attempts to keep that contained going to be successful?
So we do think that the current U.S. administration is very focused on avoiding oil prices and gasoline prices that are too high. What we find, for instance, when looking at media mentions of gasoline prices, is that media attention, for instance, for U.S. retail gasoline prices really picks up when U.S. retail gasoline prices are above $3.50 per gallon. Currently, we're in the low threes. So we think we're still at a level where energy prices are not a major affordability or political issue for the U.S. administration. And so we think that prices in the low 80s are okay from the energy affordability political perspective. And then I think what's underappreciated is that the other big goal of the U.S. energy administration policies is U.S. energy dominance, making sure that the U.S. continues to expand production. And that requires, based on our models, oil prices roughly above $70 per barrel. Because if you drop into the 60s, let alone 50s, U.S. shale supply growth would slow down a lot, and the administration would not achieve its objective to continue to expand U.S. energy exports and U.S. energy dominance. And so our 70 to 85 forecast range is pretty much the sweet spot, the intersection of both energy affordability for consumers and energy dominance for the producers.
Really fascinating stuff, Daan. Thank you very much and have a great weekend.
Thanks a lot. You too.
We're wrapping up today's market domination, but don't go anywhere. We got you covered with all the action following the closing bell. And by the way, into the closing bell, we remain around the lows of the session. The Dow and the S&P 500 having their worst single session going back to December 18th. In the case of the NASDAQ, it's going back to January 27th on a worse than expected economic data this morning. All three major averages selling off. We'll have the close for you next.